Bring in Citi Chief U.S. Economist Andrew Hollenhorst here at Post 9 to kick around all these issues. Andrew, so we have the persistent strength in the labor market, at least to date. You know, we have some stock market wealth being built up. The official inflation numbers have come down, but certainly far from target. Where does that leave us with the Fed outlook? The market seems pretty comfortable incrementally pricing in quarter points every several weeks, but can that continue?
I think that's the big question. Are we kind of in this fine-tuning period when the Fed's just trying to figure out, is it going to be 25 more? Is it going to be 50 more? I don't think that's going to have a huge impact on the macroeconomy, on markets. The real question is this tight labor market, the rebound we're seeing in housing. We're starting to see some signs that maybe the Fed's going to have to push a little bit further. So I don't think we'll get a lot out of these minutes today, but that's really the story that we're looking for.
So what does the Fed have to actually do? I mean, obviously they have to achieve their inflation target, but there's been some comfort building on Wall Street, I think, that it didn't mean that they were, targeting some certain unemployment level that they need to lift it to, or that they have to really tighten financial conditions a lot more from here and get markets lower.
Yeah, if you think about the 10-year Treasury yield, the 10-year Treasury yield actually peaked in the fall of last year. So there's a sense in which financial conditions were maximally tight some months ago. And now what the Fed is doing is watching the economy, trying to see if there's enough kind of organic slowing in the economy, the monetary policy that's already been put in. Maybe there will be, and that's really what we're just watching the data to find out now.
Steve, I want to pick up on something you just said. Why has Wall Street gotten it so consistently wrong for so long in terms of the monthly jobs report?
It's a good question. I will say, Morgan, that adding up the miss was a lot easier than explaining the miss. I think the issue is this. One is that they think that we're out of workers, so where are the workers going to come from to fill it? But we keep finding workers that are coming back into the workforce. That's one. Two is I think they believe that the cumulative effect of all of these rate hikes will finally slow some sectors of the economy. The trouble that we're seeing is two key sectors, housing and autos, which should be the most credit sensitive, are not really showing it. And by the way, just on that factory orders number, I don't know if you saw it, but the shipments of non-defense factory, the business investment proxy, that was actually up. That'll feed into GDP. I don't know if Andrew has a thought on that, but even though the orders was revised lower, the shipments, at least on the business investment side, were not. And the total new orders was not changed. So we're not really seeing weakness there either. The Fed has not had the kind of effect on the economy that I was hoping to have had by now.
Andrew, do want to get your thoughts on that. And also on this idea of, OK, U.S. manufacturing has been very weak. Does that portend slowing in the services side of the economy? Or given the fact that services has been so resilient, will we start to see that positively impact manufacturing at some point?
Yeah, so Steve's exactly right. We just haven't seen the slowing in the economy you would have expected with interest rates rising as much as they had. Housing is maybe the best example. We had multiple quarters of significant contraction in the housing sector, but the jobs numbers were still positive in most of those months. So that's kind of the dichotomy that we have between a really strong labor market and manufacturing, some other sectors of the economy that have been weaker. So yes, manufacturing has been weaker, but remember, we're coming off of extremely strong demand for goods that we experienced during the pandemic. The U.S. consumer is still shifting back towards services away from manufacturing. So when you look at those manufacturing numbers, I mean, again, to Steve's point, the fact that we're actually up in some categories, we still have residual demand for autos. I think that's showing us that not only is the labor market stronger than we thought, the U.S. consumer is stronger than we thought.